$32 billion, 1 year, and a math error that didn't add up. In 2022, Sam Bankman-Fried was crypto's golden boy, the world's youngest billionaire, the effective altruist who would give it all away. Politicians took his money, celebrities took his stage, the Super Bowl took his ads. 30 days later, it was gone, all of it. Customer funds, trading profits, the effective altruism. The only thing left was the math, and the math was never mathing. Welcome to the Autopsy. This is FTX. To understand the collapse, meet the boy who built the bomb. Sam Bankman-Fried, SBF. 28 years old when it started. Frizzy hair, wrinkled shorts, the aesthetic of a grad student who forgot to sleep. The uniform was calculated. The Messiah complex was real. The origin story was perfect for crypto mythology. MIT physics major. Jane Street Capital, Wall Street's most secretive trading firm. Then the epiphany, crypto arbitrage. Bitcoin traded at $10,000 in America, $10,200 in Japan. Buy low, sell high, print $10 million a day. He quit Jane Street in 2017, founded Alameda Research, named after the California county where he grew up. The trading firm made him rich. But SBF wanted more. He wanted infrastructure. He wanted respectability. He wanted to build the Goldman Sachs of crypto. FTX launched in 2019. Futures exchange, derivatives, the sophisticated traders platform. Not Coinbase for retail tourists. This was for pros. Leverage up to 101 times. Margin trading. Tokenized stocks. The product was genuinely innovative. The compliance was theater. The growth was explosive. $8 billion daily volume by 2021. Sponsorships with Tom Brady, Larry David, Steph Curry. The Miami Heat's arena became FTX Arena. SBF testified before Congress, dressed like a slob, playing the regulatory clarity advocate while building a bomb in the basement. The peak was July 2022. FTX valued at $32 billion. SBF worth $26 billion personally. He bailed out BlockFi, Voyager, Celsius, crypto's savior, buying distressed assets with customer deposits he didn't have. The body looked like a financial institution. It was a Ponzi scheme in cargo shorts. API endpoints that let them see orders before execution. Second, the FTT token. FTX created its own cryptocurrency, FTT, out of thin air. No blockchain utility, no governance rights. Just a loyalty point dressed as equity. Alameda held billions of FTT as assets. FTX listed FTT and manipulated the price. When FTT traded at $50, Alameda's balance sheet looked solvent. When FTT hit $1, they were insolvent. This was the entire scam. FTX took customer deposits, dollars, Bitcoin, Ethereum, and loaned them to Alameda. Alameda bought FTT tokens, pumping the price. The pumped FTT became collateral for more loans from FTX. A circular perpetual motion machine powered by customer money and self-printed tokens. Third, the risk engine was Excel. FTX had no CFO, no board of directors, no audited financials. SBF managed $32 billion with a spreadsheet he updated manually. Customer balances were negative in some currencies, meaning FTX had spent more than they held. The shortfall was $8 billion, gone, traded away by Alameda, spent on real estate, donated to politicians, or simply lost in bad bets. Fourth, the effective altruism was reputation laundering. SBF gave millions to media outlets, Vox, The Intercept, ProPublica. He funded pandemic prevention, climate research, Democratic candidates. The philosophy was real, the money funding, it was stolen. When customers asked for withdrawals in November 2022, SBF told them, "We're fine, assets are fine." while internally, the spreadsheet showed negative $8 billion. The contagion was speed. In crypto, bank runs happen in hours, not days. On November 2nd, CoinDesk published Alameda's balance sheet, heavy on FTT, light on real assets. On November 6th, Changpeng Zhao, Binance CEO and FTX rival, announced he was selling $530 million of FTT. The price collapsed 80% in 48 hours. Customers panicked. $6 billion in withdrawal requests in 72 hours. FTX paused withdrawals. SBF tweeted apologies. The risk engine that didn't exist couldn't calculate the whole. The disease was simplicity itself. He took customer money and spent it. Every sophisticated trader, every celebrity endorsement, every political donation was theater to hide a basic theft. The bleeding was public, humiliating, and recorded on Twitter in real time. November 7th, SBF assures users FTX is fine, assets are fine. The tweet is still up, a digital corpse. November 8th, FTX halts withdrawals. Alameda's website goes dark. The FTT token trades below $5. November 9th, Binance signs a non-binding letter of intent to acquire FTX. Due diligence takes 1 day. They find the $8 billion hole. The deal dies. November 11th, FTX files for Chapter 11. SBF resigns. The bankruptcy documents reveal 134 corporate entities: FTX Japan, FTX Europe, FTX Bahamas. Shell companies moving money through jurisdictions with no oversight. The autopsy details were grotesque. Customer funds used to buy SBF's parents a $16 million apartment in the Bahamas, a $30 million penthouse for SBF and 9 roommates, $700 million in personal loans to SBF and his lieutenants, political donations that may require clawbacks from candidates. SBF didn't flee. He stayed in the Bahamas, gave interviews, tweeted thread after thread of apology and obfuscation. "I fucked up," he typed. "I should have been more careful." As if $8 billion was a rounding error. December 12th, Bahamian police arrest him at his penthouse. The indictment comes: wire fraud, securities fraud, money laundering, campaign finance violations, 8 counts. Potential sentence: 115 years. The trial was a formality. SBF's defense: "I didn't know. I was bad at accounting. I trusted others." The jury didn't buy it. His closest lieutenants, Caroline Ellison, Gary Wang, Nishad Singh, had all pleaded guilty and testified against him. The spreadsheet didn't lie. The witnesses did. March 2024, convicted on all 7 counts. November 2024, sentenced to 25 years. The judge called it one of the biggest financial frauds in American history. The body was buried in federal prison. The creditors fight over scraps. The FTT token still trades, meme coin value, 0 utility, a reminder that the math was never mathing. The Y incision, the cut that reveals cause of death, points to May 2022. The Luna collapse. Terra USD, the algorithmic stablecoin, imploded and erased $40 billion in 72 hours. Alameda Research held massive Luna positions. They lost billions. The hole in FTX's balance sheet opened then and never closed. SBF had a choice: admit the losses, wind down responsibly, face the music, or hide the hole, keep trading, hope the market recovered. He chose the lie. Every customer deposit after May 2022 went to plug a leak that was already fatal. The autopsy proves FTX was dead for 6 months before November 2022. The tweets, the bailouts, the political donations, all cadaveric spasm, nerves firing in a corpse wearing cargo shorts. The incision reveals something darker. SBF knew. The spreadsheet he updated manually showed the $8 billion deficit. He saw it daily. He chose to raise more money, hire more celebrities, donate to more politicians, rather than close the doors. This wasn't negligence. It was intentional. The effective altruism became effective nihilism. If the ends justify the means, and the end is saving humanity, then stealing from customers is just redistribution. The philosophy didn't survive contact with the ledger. The ledger always wins. The lesson of FTX isn't crypto is a scam. It's older than crypto. When you can't audit the books, don't deposit the money. When the founder plays a character, messy hair, wrinkled shorts, effective altruist, ask what the costume hides. When the balance sheet includes self-printed tokens, the math is theater. SBF built a $32 billion company on Excel and vibes. The due diligence was celebrity endorsements. The risk management was hope. In business, trust is earned by transparency. FTX bought trust with stolen money. The bill always comes due. This was the profit autopsy. Next case, Blockbuster.